Right now, while you're watching this, something quietly dangerous is sitting inside the global banking system. A web of debt-linked bets and leverage so massive that if one big piece snaps, the shock doesn't stay local, it spreads fast. And the scary part is this: the headline event is never the real cause. It's just the match that lands on gasoline. Here's what happened. Banks and big institutions stacked huge derivative exposure on top of record global debt. Then rates moved, hidden losses surfaced, funding got tight, and a few safe names proved they weren't safe at all. That's the event. And if you think that sounds like 2008, you're right. Except this time the connections are tighter and the exit doors are smaller. In this video, I am going to walk you through the exact four-stage pattern that shows up in every major banking blow-up. Then I'll show you where we are on that map today, what the cracks look like in real time, and what signals to watch before the crowd even realizes something broke, and near the end, I'll give you a simple timeline. So you can see why the next wave, if it fully kicks off, could make 2008 feel like a warm-up. But first, quick favor, because I need your help. I am running a campaign to push back against copycat channels that recycle original work and bury the creators actually doing the thinking. If you get value from what I do, support the campaign, subscribe and drop a comment that says Og John AG. That one comment helps more than you think, and it tells the algorithm you want the real thing. And since we're building a real community, I also opened a WhatsApp channel for the core audience. Daily updates, quick notes, and when something major breaks, I'll post the update there first. Link is in the description. Join it so you're not relying on random notifications. Alright, jumping in, because once you see this framework, you can't unsee it. Across thousands of years, major banking crises follow a pattern so consistent, it's almost mechanical. 4 stages, different costumes, same play. Stage 1 is stability, people feel safe. Safe leads to trust. Trust leads to lending. Lending leads to expansion. In this stage, everyone believes the system is smarter than the past. Comfort makes people forget that risk never disappears, it just hides. Stage 2 is overreach. Credit grows faster than real assets. Leverage creeps up. Risk gets chopped up, packaged and sold as managed. Complexity becomes camouflage. Stage 2 can last a long time, which is why most people fall asleep during it. Stage 3 is the crack, a default, a bank run, a rate shock, a geopolitical jolt. But the crack isn't the cause. The crack is the reveal. It exposes the weakness that was already inside the foundation. Stage 4 is contagion. Liquidity vanishes. Funding freezes. Institutions that were fine yesterday suddenly need emergency support. Governments step in. Central banks print. The currency absorbs the pain. Then the cycle resets, usually with a huge wealth transfer. Let me prove it with 3 examples. I want you to notice how the details change, but the structure stays locked. First, Rome 33 ad. Their credit system was advanced. Private lenders, real estate speculation, networks of loans. Stage 1 was done. Stability produced confidence. Confidence produced borrowing. Borrowing produced a boom. Then stage 2, credit, stretched beyond solid collateral. Safeguards got ignored because everyone assumed the good times were the new normal. Stage 3 arrived when rules started getting enforced hard. Lenders had to comply quickly, so they called loans in. Borrowers couldn't pay, so they dumped property for cash. Too many sellers. Not enough buyers. Prices collapsed, and the collateral behind loans collapsed with it. Stage 4 followed. The credit market froze. Even wealthy players couldn't access liquidity. Authorities had to inject massive support and create special lending programs to stop a full financial heart attack. Rome didn't nearly fall to an army that year. It nearly fell to a balance sheet. Second, the great European banking houses of the Renaissance. Stage 1, trust built over decades. Stage 2, expansion into dangerous borrowers, especially royalty, because saying no to power is hard. Loans grew, concentration risk grew, and the illusion of safety grew. Stage 3 hit when politics shifted and a guaranteed borrower stopped paying. One major failure made depositors ask the killer question, is my money really there? Stage 4 was contagion. Withdrawals accelerated across regions. A reputation built over generations dissolved in a short span, not because cash vanished, but because trust did. Third, America in the 1920s. Stage 1, prosperity and optimism. Stage 2, leverage tied to asset prices. People buying stocks with tiny down payments. And borrowed money. Stage 3, a drop triggered margin calls, which forced selling, which pushed prices lower, which triggered more margin calls. Stage 4, bank failures turned a crash into a depression. savings wiped out, jobs gone. It took years and extreme measures to rebuild. Same pattern, different decade. Now here's the uncomfortable truth. None of those societies saw it clearly in real time. They saw it in hindsight, and by the time the public agrees this is a crisis, the transfer of wealth is already underway. So where are we now? We're in late stage 2, sliding into stage 3, and I'm not saying that for drama. I'm saying it because the fingerprints are everywhere. Debt expansion, leverage, complexity, and then the first visible fractures when the cost of money changes. After the last major crisis, central banks pushed rates down near zero and made money cheap on purpose. That rebuilt the foundation. Stability, confidence, the feeling that the worst was behind us. Markets recovered, people relaxed, and once people relax, they borrow. Cheap money encourages leverage. Governments borrow more. Corporations borrow more. Consumers borrow more. And because borrowing feels painless at low rates, the entire system builds a lifestyle around it. You don't just borrow, you plan your future around borrowing. Here's the problem. Solving a debt crisis with more debt only works if debt stays cheap forever. The moment the cost of debt rises, the math flips. And when the math flips, hidden losses stop hiding. Over the last decade plus, global debt climbed to levels that would have sounded absurd not long ago. Corporations borrowed not just to build, but to buy back stock, boost earnings per share, and keep asset prices elevated. That isn't a conspiracy, it's incentives. But incentives can create fragility, and while most people were watching, stock charts, another machine kept growing underneath. Leveraged corporate lending and structured products built on top of it. Risky loans, bundled, sliced, and sold as diversified. If that gives you a flashback, good. The theme is the same. Spread risk around, rename it, and pray liquidity never dries up. Now let's talk about the word everyone hears but few people unpack: derivatives. Derivatives can be useful, but when exposures get enormous, they create a web of counterparty dependency. Your stability isn't just about your assets, it's about whether the other side can pay when the contract gets tested. And when that web is concentrated among a few giants, it becomes a domino setup. One failure forces the next to reprice risk instantly. This is why stage 3 is so dangerous today. The crack doesn't need to be huge, it just needs to hit confidence and funding. And this is where mainstream financial media usually gets it wrong, or at least incomplete. They'll talk about one bad bank or one isolated sector as if the problem is a single tree. But the real danger is the forest, the funding chains, the collateral chains, the cross-exposures that don't show up on the headline. So if you want to see what's real, look at what banks do when nobody's watching. How they fund themselves, how they mark their assets, and what happens when depositors and lenders demand cash right now, not later. A modern crack looks like this. A bank holds safe assets that are underwater in market value. Long-duration government bonds can drop hard when rates rise quickly, if the bank has to sell to meet withdrawals. Paper losses become real losses and real losses hit capital. Now add digital bank runs. No lines, no waiting, just a phone. Billions can leave in hours. Same psychology as history, new speed. When a few banks failed in a short window recently, the lesson wasn't only bad management. The lesson was, calm can flip to panic at smartphone speed. The tools used to stop panic often involve backstopping losses with programs that treat impaired assets as if they are still whole. That buys time. It doesn't remove tension. Add another pressure point: commercial real estate. Office demand shifted, vacancy rose, and refinancing happens at higher rates. Values don't need to collapse to hurt banks. Smaller declines can break loan math when the new payment is higher and the building ease income is lower. Then there's global funding and carry trades. When investors borrow cheap in one currency and chase yield elsewhere, it works until the currency strengthens or rates rise. Then positions unwind. Unwinds mean forced selling. Forced selling drains liquidity from places you wouldn't expect. That's how stress jumps borders. Now here's a point that keeps people trapped. They hear authorities will step in, and they assume that means problem solved. No, it means problem moved. Emergency support can stop the bleeding, but it also changes incentives. It tells markets that risk will be socialized, which can encourage more risk later, and it often comes with a price, either inflation over time or restrictions and rules when the next wave hits. In other words, even when the system gets rescued, the public still pays. The bill just arrives through different channels: purchasing power, taxes, bail-ins, reduced services, or years of living smaller, because real wealth got diluted. And if you're thinking, okay, but how do I know when the real turn happens? Good, Because that question is exactly what stage 3 is about. The turn is not when a famous name collapses. The turn is when trust in short-term funding cracks and the market starts demanding a higher price for liquidity. Now here's the cliffhanger. The first headlines usually look contained: one bank, one sector. Meanwhile, the real story is the funding market tightening, spreads widening, and lenders refusing to roll risk at the old price. That's why you watch signals, not slogans. So what signals matter? 1. Credit spreads. When lower quality borrowers suddenly have to pay much more than governments, the market is whispering that default risk is rising. 2. Stress in smaller or regional banks with concentrated exposures. The giants get the spotlight, but edges crack first. 3. Rising delinquencies in interest rate sensitive sectors, commercial property, and highly leveraged corporate debt. 4. Sharp currency moves that reflect liquidation or loss of confidence. Either direction can be dangerous for different reasons. 5. Temporary emergency facilities that quietly become semi-permanent. History is full of fixes that never leave, because removing them would reveal weakness. Now, quick creative side note. If you also like silver-related success stories, real people, real wins, there's a link in the description to a separate channel focused on that. If you enjoy learning how others built momentum and made money, subscribe over there too. Back to the main thread. If stage 3 accelerates, stage 4 starts with a larger institution failing or needing rescue that triggers repricing across counterparties. Everyone asks, who else is exposed? Uncertainty becomes contagious. Banks face deposit pressure. Investors refuse to refinance shaky borrowers. Asset prices drop, not always because they're worthless, but because forced sellers need cash now. Authorities respond because they must. No government can allow the payment system to collapse, so they provide liquidity, guarantees, and support. The problem is that support often comes through balance sheet expansion and currency debasement. When you print to absorb losses, you change the value of the unit you print. This is where people get confused. The sequence can be both deflationary and inflationary. Panic can push asset prices down first, and the response can push purchasing power down after. That's why the next crisis can feel like portfolios down, costs up, brutal. Now let me give you the timeline the way I look at it as I'm recording this. In the near term, stress shows up as volatility, not just down days, but violent whipsaws, big drops followed by sharp rebounds. That's not a healthy price discovery. That's a system searching for liquidity. In the next phase, you see quiet tightening, lenders get picky. Borrowers who were fine at low rates suddenly have to refinance at numbers that don't work. Defaults start as isolated, then cluster. The phase after that is the one people remember, the public panic phase. A recognizable institution fails. Depositors get nervous. Systemic risk starts showing up on TV every hour. When you hear that phrase non-stop, it's already late. Now I also want to address the psychological trap that makes people do the wrong thing at the wrong time. When stress rises, people chase certainty. They sell what they can, not what they should. They dump assets at bad prices to feel safe. Then they miss the rebound or get stuck in cash while purchasing power erodes. Preparation isn't about panic selling. It's about having a plan before emotion takes the wheel. And this is where I usually get a viewer question. So let me answer it the way I'd answer it if you asked me directly. The question is, if the system is so fragile, why hasn't it already collapsed? Because stage 2 can be long, and because interventions can extend it. When support exists, the collapse doesn't happen on the schedule you want. It happens on the schedule the math demands, and the math only demands it when enough stress stacks up at once. Rates, refinancing, confidence, liquidity, and a trigger. In other words, the system can look fine, right until it doesn't. That's not paranoia. That's literally what every banking panic in history looks like. And this is where the "this time is different" blind eyes. Rome said it, banking houses said it, the 1920s said it. In every era, people claimed the rules changed, the world changed, the pattern didn't. Because the pattern is human incentives inside a debt system. When leverage rises faster than resilience, small cracks become structural breaks. So what do? First, measure exposure, don't guess. If you have cash, understand where it sits and what protections exist. If you have debt, understand the terms and how tightening credit hits you. If you have investments, understand which ones rely on cheap money and constant value. Second, diversify in a real way, not 10 things that all depend on the same credit cycle, but exposure that doesn't all break the same way at the same time. Third, reduce personal leverage where you can. Stage 4 doesn't just punish the uninformed, it punishes the over-levered. Fourth, build flexibility. Liquidity is an option. Options matter when markets dislocate. And fifth, keep learning and keep sharing. If you've done something that worked, an investment win, a business move, a debt payoff, share it in the comments. Your story can lift someone else's standards and keep the community sharp. I'll ask again later too, because this matters. Now let's lock in the big conclusion. We're not staring at a single bank problem. We're staring at a system built on cheap credit facing higher rates, aging debt, and interconnected exposures that transmit stress quickly. Stage 2 has been building for years. Stage 3 has shown itself in flashes. Stage 4 is the outcome if a bigger crack hits at the wrong moment, and the reason this could make 2008 look small is scale, debt levels, speed, interconnection. When the system is larger and more synchronized, failures can be larger and more synchronized too. One last thing before you scroll, pay attention to how quickly narratives shift. One week, the media will say banks are well capitalized. Next week, they'll say a rescue is precautionary, awarding matters. When they switch from confidence to reassurance, you're watching stage 3 in motion. And if you want, in the next video, I'll break down a simple checklist you can run on any bank headline in 60 seconds. What to ignore, what to respect, and the one number that often predicts whether it's noise or the start of contagion. If you want that checklist, type checklist in the comments so I know to make it. I'll share it on the WhatsApp channel first. 2 questions for you. Answer both in the comments. First, what do you think becomes the next crack that turns into a major headline? Commercial real estate, a large bank, corporate defaults, or something totally unexpected? Second, if you had to pick one indicator to watch weekly to spot stress early, what would it be? And one more friendly request. If you're successful right now, business, investing, career, share one lesson in the comments. It helps someone else in a way you might not realize. Finally, if you support the campaign against copycats and you want the original work to win, subscribe and comment Ogjonog. And don't forget the WhatsApp channel in the description. Daily updates and quick alerts when things move fast. Stay sharp, take care of your people, and I'll see you